of ratios. Okay, and this is calculated, and we will do this calculation in our Excel sheet also. The pyramid of ratio calculation we will do in our Excel sheet also. But let us see. You have net income by equity. This is mother of all ratios, right? Then it is made up of these ratios in different levels. The primary ratios are three: net income by sales, sales by total assets, and total assets by equity. And we have learned all these ratios, right? We have looked at all these ratios in our earlier discussion. Okay, so these are called as three levers of net income by equity. Okay, so if you multiply all these three ratios, you will get net income by equity. Yes, net income is equals to net profit, Amar. Net income is equals to net profit. Okay, this is your primary ratios. Okay, so any pyramid of ratios will have these three ratios on the top. Then you have secondary ratios, okay, which is operating income by sales. So it is giving you net income by sales, sales by total assets, and total assets by equity, right? So these are three main ratios. And if you see why I am saying that this will make net income or equity ratio is like this. Net income, how it will look if you multiply all these three, what will happen? Guys, are you able to visualize what I am trying to say? Let me do this for you. Okay, this is quite interesting. The net income has three drivers basically. When I'm saying these three drivers, let me just put these three drivers. Yes, Sumeg, exactly. That's what I'm trying to show. Can you see my Excel and my PPT both, guys? Okay, so you see net income by sales, correct? This is one ratio. Sales by total assets is another ratio, and total assets by equity. One second, I will just put it across. Huh? I will just put it across if you are not able to see the Excel. Now you can see the Excel. Look, what I have done is I have just typed in. Is it visible now? Okay. I have typed in those three levers basically. Okay. And how your this thing net income by, I'm saying this is net income by equity, which is my mother ratio. This is my mother ratio, is actually a function of these three ratios. And if I multiply this, I can't put a if I multiply this, okay, I will just ignore the formatting bit for this. Okay, if I multiply these three ratios, okay, it is going to give me the same result which I am talking about. How it will happen? We will not go to numbers again. Conceptually, you see, if you multiply one such equation, what will happen? Sales will get knocked off with sales, right? Total assets will get knocked off with total assets. What will left is your net income by equity. So can we say that net income by equity can be better understood by dividing it into these three ratios? Can we say that? Guys, are you with me? So isn't it a drill down of this net income, these three mother ratios? From this mother ratio, three sub ratios, primary ratios, right? Okay, great. I will go back to my pyramid of ratios, right? So this is basically, Kushal, we can say that is right statement which you are saying, but this has to be this way. Okay, so to analyze your net income by equity is a high level thing. How much impact it has through sales, through assets, through total assets, is all comes through these three ratios. Then again, these ratios are further divided. Okay, net income by sales is again having a bifurcation of operating income by sales and net income by pre-tax profit. Okay, now this gives an indication of efficiency, efficiency basically, and profitability, right? The last ratio which is there, net debt about by EBITDA, gives a good indication about solvency. Okay, and sales by PPE and sales by working capital gives good indication about the efficiency of these items. Are you guys with me? Then you have treasury ratio, okay, which is like a third level ratio. Okay, and again you can use it the way you want, and you may have more, but again it is broken down. These ratios are again broken down into respective ratios like gross profit by sales, labor cost by sales, R&D by sales, overhead by sales, depreciation by sales, right? Marginal cost by sales, selling cost by sales, right? So it is more about income. It is not giving you any indication about the solvency thing, right? They are in the nature of performance ratios, right? Profitability and efficiency ratios. And this is completely efficiency ratio, right? So you don't have any corresponding debt ratio here in the third level of details, right? But we will include some third level of data as well when we will do the pyramid of ratios. Okay, now let us see how the pyramid of ratios look like. This is the pyramid of ratios. Okay, the blue color is the primary ratios. Okay, blue color is the, so return on equity, if you multiply these three numbers, it will tentatively give you approximately this number. You can do it for all the years. So you see, this is a pyramid of ratios for 5 years of a company, right? So you can say that there is a constant increase by just looking at the top level detail of this company. You can say that there is a constant increase in the return on equity of the company. Are you guys with me? Right? So which gives you a very good comfort that yes, your company overall is doing really good. Now you look at it, okay, from where this contribution is coming from. When you have reached to 32% from 18%, from where this contribution is coming from, right? Are you utilizing your assets well through these two ratios, or your net profit margin is increasing? But you see, your net profit margin has been little volatile. So in the first year, in the 2007, there might be some contribution because of net profit increase, right? In the second year also there might be some contribution, but in the third year and in the fourth year, net profit has gone down, but still your return on equity have increased. So that means your total asset to equity, right, and your asset turnover has increased. So you see, there has been a constant increase in your asset turnover ratio. That means your scale have increased. What does it say? What does this ratio say? Technically, your scale of operation has increased, but per 100 rupees of sales which you did resulted into a lesser net profit earning for your company. Are you guys with me? And there has been a better, uh, you know, asset to equity ratio has also increased. But in this current situation, these two things plays an important role in making that what is contributing to this return on equity. So you don't have to go through the numbers of a company. You don't have to go through the balance sheet of the company if your ratios are well managed. Here you can easily say, if my net profit is not increasing, right, that means my turnover has increased, which has compensated a better return on equity for me. That means it should come from better asset turnover ratio. Getting my point, guys? Am I making sense? Yeah. Okay, great. Now second level, we will go to the second level. Second level, we have few ratios, right, which are capital structure impact ratio, that how your capital structure has moved from 1.16, it has moved to 1.01, right? So leveraging is decreasing in this. Tax ratio somehow has been consistent, but there has been some dip in the mid of the year, 67.58. Okay, then I will just come. I am seeing some questions on the chat box. Let me just finish this. Working capital turnover ratio, again from 5 it has dipped, but it has come back on the top, right? Tax ratio hai, you have PPE to capital asset turnover ratio, right? So you have this ratio also, which has shown some up and down, right? What we will do, when we will do the practicals of it, we will go into more details of 1:1 ratio at one time. Hmm? I will just come to the questions on the chat boxes. Okay. EBITDA margin, you see, EBITDA margin is also on a decline basically, right? Earning before interest and tax is also on a decline, which matches to our conclusion of net profit basically, right? Which matches to our conclusion that there has been, so one thing which you can conclude here is there has been a shrink or a pressure on the margins on this company, but at the same time company is able to utilize its assets well enough and able to penetrate in the market to increase its sales. Now we don't have the absolute number of sales here, right? But if we have, this is just a sample basically, this is just a sample. So if we have an absolute number, our conclusion would definitely be corroborate with the facts which we will have. Okay, so that is how our secondary ratios are there. Okay, now okay, so first I will take Lalit's question. Lalit sir, here the point is that you are not investing so much. If you see, your capital structure has come to 1:1 from 1.16, right? So that means that means that the point here is that your capital structure is here and your gross profit and net profit margins are decreasing. Okay, and your asset turnover ratio is improving, that means your sales is improving. Basically, your sales is increasing without a proportionate increase in your asset base. No, you cannot say your gross profit is one thing. Sir, I'm saying if I'm making a sale of 100 rupees, right? If I'm making a sale of 100 rupees, right? And my gross profit is 50 on that, correct? But if, and my equity investment is fixed, let's say I put in 10,000 rupees. So say I have a 5% return on equity in that particular case, right? But if my sale is increased, right? If my sale itself is increased without increasing my equity, my returns are increasing, no? Because my free cash flow, which is coming to my business, is increasing. That's what it reflects. Am I able to clarify your doubt, Lalit sir? The point is, we are talking about volumes here and not per rupee how much we are earning. We are saying we have increased our revenue itself by keeping the asset base constant. Let's say 10,000 rupees of the asset base, we have kept it constant. Our my sale has doubled, or let's say increased by 50%, though my gross profit has a pressure. Lalit sir, am I clear? And then I will come to the other questions also. And it's a very good debate to have, actually. I liked it. Okay. So that we interpret these things well. Lalit sir, I will wait for your reply. It's about volumes, sir. It is about volumes. My company is increasing the volumes with the same base. Okay. Let me take Kaustubh's question. I'm going in the reverse order. Total asset to equity decreasing is good for the company because of lesser reliance on debt. Yes. Yes. Right? Okay. No, we have not come to S&A ratio till now, Naveen. We will come to that. Asset turnover ratio. Asset turnover ratio. What was the formula of asset turnover ratio? Can someone tell me? Can anyone tell me asset turnover ratio formula? Sales upon total assets, right? So that means each rupee which you are investing in your asset, how much revenue it is earning. So asset turnover ratio says that, okay, you have 100 rupees of asset investing. Okay, let's assume that there was no increase in the asset in this year, but your sale have increased. So that means your assets are getting better utilized. So betterment of this ratio indicates that the turnover or the utilization of the asset is better. You are not investing that much, but you are increasing your sales. Getting my point?